So here in this video, we will be going over what in the world happened today in markets. The S&P 500 is down almost 1% at the time of recording this video with a pretty obvious technical breakdown. Other stocks are down a lot as well. Nvidia was up about 10%. Now it's only up 8.7%, but you're still up 8.7%. Why are markets selling off so aggressive? I think you guys need to hear this. On top of that, we will be going over a bunch of other things like how positioning looks in our markets, what Dan Ives just said about Nvidia, as well as Tom Lee. Remember what Tom Lee just said before Nvidia reported earnings? That if Nvidia came out and beat and raised, that would actually cause a broadening out of our markets. Well, I'm here to say, I think it's obvious what we need. We actually need Nvidia to sell off. And there can be good news on that front. And this will lead to a broadening of our markets. But more on that later. So first, let's start off with the obvious what happened today. Nvidia was up 10% for a majority of the day today. It did start to fall towards the end of the trading day, but really the markets started off bad today. As Nvidia fell, that just made markets get even worse towards the end of the trading day. All of your major indexes had pretty bad days today. This is what Dan Ives said following Nvidia's blowout quarter.
You've been pounding the table on it. You've been right. $1,000 a share, guiding $1 billion over forecast. I'm trying to find something to ask you where there might be a hole in the story, but I just don't know.
The party's just getting started. I mean, I believe this is really this AI revolution that's playing out. And it's not just for the godfather of AI, Jensen, NVIDIA. You look across tech, we're going to be talking about $3-4 trillion types of valuations in tech. There is no slowing down. Brian, I think even the bulls, this is a drop to mic quarter in terms of this. And look, you have bears out there, of course, like Ross Gerber and others on valuation. But I think this is just starting. It's a 1995 moment, not a 1990.
I guess if I had to poke, you've been pounding the table on it. You've been right. $1,000 a share, guiding $1 billion over.
So Dan Ives is clearly bullish on Nvidia, bullish on other stocks like Tesla. He tends to cover really your tech sector, so not a big shocker. But I did find it interesting. He was talking about $3-4 trillion plus valuations for some of these tech names, and that could be a long runway of growth from here. So what really happened today was Nvidia outperformed, and when you have Nvidia outperform and give you a blowout quarter and go up 10% in a single day, fund managers, they almost need to chase that or they're going to lose clients, especially if they are not allocated enough to Nvidia or to the semiconductor sector. So what you had today was institutional investors that sold other positions in other stocks, Tesla, PayPal, Fubo, SoFi, CRISPR, Dollar General, just some of these stocks that I own that were selling off big today, and putting that money into Nvidia because whether or not they want to, you gotta own Nvidia or your clients are not gonna be happy with you. And you might not keep your job if Nvidia keeps rallying and you have no exposure to it. I think the other aspect to this is the S&P went from about 5,000 on the SPX all the way up to about 5,300 or 530 on the SPY right before Nvidia reported earnings, and there was a lot of this good news already baked into the stock. Now Nvidia gave us a little bit of a wild card because they threw in the stock split news, and I think that's why Nvidia is really up today. But now that Nvidia is out and over with, there is a little bit of the sense of what's the next catalyst. Well, we don't have a catalyst for a while, at least one that definitively should be a bullish catalyst like Nvidia earnings. It's a literal no-brainer. Nvidia is going to come out, beat and raise guidance. Everyone expected that heading into the quarter. Now, if they hadn't beat, well, that would have been bad, but they clearly did. So what do you get now? You get a little bit of reset from investors saying, hey, maybe now we can pull some off the table. You also have a pretty interesting technical breakdown on the S&P and the NASDAQ, and we'll talk about that a little bit more later on into this video. Now, Tom Lee just said yesterday that he believes a new tech cycle is currently underway, and this could last into the 2040s. Tom Lee also said that he expects if Nvidia beats on earnings, you could actually see a broadening out of our markets, and I do still think that is possible, especially when you get Nvidia that starts to fall again, because if Nvidia starts to fall over the next couple of days, which it typically does after a gap up after earnings, have about a 2 to 3 week period where it kind of trades lower, usually by about 8 to 10%, then that could allow fund managers to say, hey, you know, Nvidia's moment is now past. We're probably going to get a little bit of a setback here. We don't need to, you know, continue to reallocate to Nvidia over and over again. Maybe we can go out and buy other stocks. So I still think a broadening out of our markets. I still think Tom Lee can be correct in that sense. But judging off of one day, it's not going to do you any good. Next week could be the broadening out of markets, because today is far from that. In fact, 5% of stocks out there on our markets or in our markets today are falling under their 50-day moving average. You have over 90% of stocks that are declining. So even when the markets were green in the beginning of the trading day, you still had 80+% of stocks that were falling on the day. The farthest thing from a broadening out of our markets, a contraction of our markets was actually happening throughout the day today. CNN's Fear and Greed Index today is falling, as you would expect, to 56, which is still barely in greed territory. Yesterday, you were at 58, which was a little bit more greedy. And 1 week ago, you were at 63, which was well into greed territory. Your most recent AI investor sentiment survey that came out just yesterday shows a lot of people were bullish as well just yesterday. 47.0% of investors surveyed were bullish, 26.6% were neutral, and 26.3% were bearish. This is very interesting. So the bulls went up almost 7%. Bears went up 3%. That's pretty interesting and pretty rare to see bears increase and bulls increase. Pretty interesting. Neutral investors did drop by about 9% though. So that's where it came from. People are a little bit less neutral, a little bit more bearish, and a lot more bullish. Now, following today's market decline, you're probably going to get more bears that start to come out and get bearish again. 10-year Treasury yields today are also up about 4 basis points, up to 4.47%. So that is definitely putting some downside pressure on stocks as well. Today, you did have some data that came out. 8:30 in the morning this morning, Eastern Standard Time, you had Chicago Fed National Activity Index that came in at negative 0.23. The estimate was actually positive 0.16. So bad for Chicago area activity. Initial jobless claims came in at 215,000, below the estimate for 225,000. So that was actually good news for the labor market. And maybe bad news for equities, because a lot of people want to see the labor market get worse. But overall, that's good news. If the labor market stays strong, that's good news no matter what. But this was the data that really did it today. S&P Global Composite PMI came in at 54.4. The estimate was 51.4. S&P Global Manufacturing PMI came in at 50.9. The estimate was 50.1. And S&P Global Services PMI came in at 54.8. The estimate was 51.4. So here's the deal. The markets today, seeing these numbers, this data that came in, all of them higher than expected, and said, that's bad news for inflation. That's bad news for the Fed. No, it's not. It's just showing the economy is strong. That doesn't necessarily mean that inflation was strong during the month of May. So, yes, this is just one data point. And maybe it does mean inflation was strong. I don't buy that. One of the main reasons for that is because inflation tends to track the price of oil. And oil even today is down about 1%. You hit a high of $83.41 per barrel. This was on April 12th. And I mean, now you're at $74 a barrel, right? So you're actually seeing oil decline. And the way that CPI is calculated, it's calculated 3 points a month. So beginning, middle, and the end. If you see oil fall from the start of a month to the end of the month, throughout those readings, that's going to have a positive impact on inflation or bringing inflation down. Now, rents are the biggest contributor to inflation right now, and none of this data today suggested that rent inflation actually rose. It just shows the economy is a little bit stronger than we thought it was. Now, we also had Kansas Fed Composite Index that came in at -2, estimates were -4, and Kansas Fed Manufacturing Index that came in at -1, the estimate was -8. So today's data just showed the economy is stronger than people thought. That's actually good news for stocks. Now, can that have a correlation to inflation? Of course, but when you're looking at these specific components of inflation that are around and prevalent, and that's really rents and insurance. Without those, we would be at right about 2% inflation. Those components don't really have too much to do with how strong the economy is. Of course, rents do, but this data isn't telling us that rents rose, right? This data isn't telling us that auto insurance should rise. In fact, there's actually news that came out today that maybe rents should fall soon. And here's this article from CNBC. It says auto insurance rates are jumping the most since the 1970s, but there could be relief soon. Motor vehicle insurance costs were up 22.6% from a year ago, the largest annual increase since 1979, according to Bank of America. Recent trends probably do not mean that your premium will fall, but we think the rates of increase should slow, according to Bank of America's economist Stephen Jangyu. The turbocharged increases in motor vehicle insurance premiums are a response to underwriting losses in the industry. Insurers saw losses. Bank of America economist Stephen Jangyu wrote in a note. I have no idea if I'm saying his last name right, so I'm probably butchering it. However, he added, there are signs that many insurers are getting back to profitability. Tomorrow morning, we will be getting some pretty big data as well. Coming out at 8:30 in the morning Eastern Standard Time, you will get durable goods orders month over month. You are expecting a negative 0.8% number. Last month was positive 2.6%. So expectations are that durable goods orders, which is orders of most things, will actually decline on a month over month basis, showing the economy is probably not that strong. Now, the data today said the opposite. Expectations were that the economy was going to be, bad or slowing down, and it came in pretty good. So I think you're probably going to come in high here tomorrow. Maybe not as high as last month's 2.6% number, but maybe a positive number, maybe a 0.2, 0.3% number. And that could be seen as maybe a negative for markets because, again, markets are just saying, hey, if the economy's strong, inflation's high, which that's not necessarily the conclusion that you should draw, but that's kind of what the markets are doing right now. So if you actually take a look at the S&P 500, you are getting quite the down day today. And that's because the S&P is down almost 1%, and you were up over 1/4% at one point today. So the actual round trip move here is even larger than 1%. Now, this is a notable breakdown down to your prior all-time highs, which is about 524.24. That's the next level to watch as potential support, and we're heading right into that right now. If you take a look, next is your 20-day moving average. If you fall to your 20-day moving average, that's around 419. You could get some support there. But as JP Morgan and as others have said, if you get a sell-off that takes you under your 50-day moving average, well, new lows for 2024 could be in play. And that's because normally when you get sell-offs, it's not just one sell-off and you get a, by the dip frenzy and then you never come back down, right? Typically, you get a sell-off, a bounce, a sell-off, a bounce, a sell-off, you know, and then a bounce, right? Multiple different rounds of a correction within a correction itself. Normally, a correction doesn't happen in just one drawdown. So this could mark a reversal that could actually lead to more downside from here. Now, I think the economy and how the economy goes, keep in mind the data that we have tomorrow morning, that will be important. We don't have many other catalysts coming here over the next couple of weeks. The next big data we will get is on June 7th with the non-farms report, and then inflation data that comes out the same day as the Fed on June 11th. So those are going to be very volatile days. But from now until then, we don't have much to look forward to. Now, I will tell you, whenever Nvidia rallies like this on earnings, you do tend to go through a period afterwards of sideways to down trading, right? Anywhere from 8 to 12% is common for Nvidia. So if you do get a sell-off with Nvidia following this rally in earnings, which probably happens, let's be honest, Nvidia has rallied $280 or so in the last month. I mean, you're probably going to get some kind of consolidation or pullback here. That's where you can actually start to see a broadening of our markets, and just average stocks starting to do a little bit better, whereas maybe big tech takes a little bit of a breather as well. And I know big tech's been a mixed bag. Apple's been outperforming recently. Stocks like Meta have been underperforming. Amazon underperforming a little bit relative to a Google, right? And again, to an Apple or an Nvidia. So I do think when Nvidia falls, that's when you do get a more broader or inclusive rally in our markets, because hedge fund managers, they almost have to own Nvidia right now, because if you don't and you're missing out on this run that Nvidia has had, your clients are not going to be too happy with you, right? Whereas when Nvidia falls, you can start to allocate to other areas that maybe you're not allocating to nearly as much. So let me know if that makes some sense. Let me know if you have questions down below in the comments section. But judging off of the technicals, we do have some levels of support again heading here, within the next 1 to 2% lower on the S&P. If you don't specifically hold that 50-day moving average, that's where things can get maybe much worse for the S&P. I don't really see a catalyst for that. But again, we do have durable goods coming tomorrow, and maybe investor sentiment has just gotten too bullish, and maybe you need a little bit of a reset back to lower levels. I'm not sure. Let me know what you think down below in the comment section. Do you think a larger sell-off is coming? Do you think this is more of a one and done kind of day for selling? Thank you for watching. Hit the like button, subscribe to the channel. I don't know if I already said that, but enjoy your day, and I will see you in the next one.